Hi everybody, this is Lara with your end of the week video for gold for the trading week ending Friday 27th of September. A short-term target for some downward movement may be at 1464 or 1420. A classic analysis target using the flag pattern is about 1426. But that flag pattern after Friday doesn't really look that clear for gold, although it was pretty clear for GDX. My bearish Elliott Wave count still expects a new downward trend to last 1 to several years is underway. The price point which differentiates my bull and bear wave counts is very clear, 1346.45. A new low by any amount at any time frame would give substantial confidence in a long-term bearish view. While price remains above that point, it's possible this is just a big consuming pullback or consolidation. Let's take a look at the bearish wave count first at the weekly chart level. It sees the bear market incomplete for gold, subdividing as a zigzag labelled A, B, C, with wave B at supercycle degree, possibly over up here, subdividing as a double zigzag. That's a pretty common structure and it fits very neatly within this best fit channel. The first zigzag in the double is labelled cycle W. From this low to this high, this upward movement fits very well indeed as a three-wave structure. It's very easy to see it as a three-wave structure. It has good proportion. It's a zigzag subdividing 5, 3, 5. There's a nice example of an expanded flatten here. This is a really common structure for a B wave, 3, 3, 5. The double of cycle wave B is joined by a corrective structure in the opposite direction labelled X. They are usually zigzags, but they can be any corrective structure, and this one fits really well as a regular contracting triangle. A, B, C, D, E. E falling quite short of the AC trend line. That's okay. E waves do most commonly fall short of the AC trend line, although not always by this, or not usually by this much. If X is over here and Y is underway, then it may be a complete zigzag subdividing 5, 3, 5. Let's look at this now at the daily chart level from the end of X. This point here, from this low to this high, this subdivides reasonably well as a zigzag. Within this zigzag of cycle wave Y, if we see a triangle complete in this position here, it has a really good fit, although primary wave C doesn't have as good a fit because there is a disproportion here within the third wave. There's a time-consuming fourth wave here and a relatively quick shallow second wave. This disproportion is only somewhat problematic though, because the disproportion is not too huge. This structure for cycle wave Y fits quite well in a best fit channel. That channel is now breached by downward movement, although for the last couple of weeks it wasn't perfectly showing where price was finding support and resistance. But now we have a red daily candlestick well below the lower edge of that channel, giving an indication that this movement is likely over and the next movement is likely underway. If there is a high in place here for supercycle B, then supercycle C needs to begin with a 5-wave structure down. So far, I'm labelling this first movement here minor wave 1, and this correction here minor wave 2, and now minor wave 3 is expected to be underway. Friday's low bounced almost perfectly off the lower edge of this little channel I've drawn around minor wave 2. I've drawn this using Elliott's technique for a correction from the start of A to the end of B with a parallel copy on the end of A. If we see downward movement break below the lower edge of this channel on the hourly chart with a full hourly candlestick below and not touching that trend line, preferably with downward movement, not sideways, if that happens, then you can have a little confidence that minor 2 is very likely over and minor 3 is very likely then underway. Minor 3 should exhibit an increase in downward momentum. At the hourly chart level, here's the end of minor 2. Within minor 3, minute 1 may be complete, very close to the lower edge of that channel. Minute 2 may continue a little bounce early next week to end either about the 0.382 or 0.618 Fibonacci ratios of minute 1, and it may not move beyond the start of 1 above the invalidation point. The target for minor 3 for the bearish wave count is for it to reach 1.618, the length of minor wave 1. At the weekly chart level, this is a very bullish wave count. It considers what if this bear market for oil subdivides as a double zigzag and it's a complete corrective structure. The bear market is over and gold, and gold began a new bull market back down here. For gold, this bear market will subdivide as a double zigzag. If that's the end of the bear market, I'm going to label a complete grand super cycle fourth wave and a new bull market beginning. If the bear market is over for gold and a bull market is underway, then the first movement up here must be seen as a completed 5-wave structure. And this is a little quite problematic, because it doesn't have a good fit and it doesn't follow normal behavior for this market. The problem is that primary 4 is grossly disproportionate both in terms of distance travelled and time taken to its counterpart primary wave 2. It's common for gold to exhibit disproportionate second and fourth waves, but it's usually the other way round. Here's an example, and here's another good example. Time-consuming second wave, brief shallow fourth wave. Time-consuming second wave, brief shallow fourth wave. That's really common for gold and other commodities. What's very uncommon is for it to be the other way round, and so this substantially reduces the probability of any bullish wave count for gold, in terms of Elliott Wave, that is. In terms of Elliott Wave, there's no problem with this corrective structure for for cycle 2. It's a double combination, zigzag, X, flat correction. If that's where 2 ends, then 3 begins, and now it's broken above resistance. It's starting to see an increase in volatility, an increase in ATR, an increase in momentum, and support from volume. If cycle 3 begins here, then the most common Fibonacci ratio for it to reach would be 1.618, the length of cycle 1, hence the target. Cycle 3 may only subdivide as an impulse. So far, primary waves 1 and 2 and 3 may be complete. Primary 4 may be continuing as an expanded flat. Here's a good example of an expanded flat, A, B, C. I expect this may be subdividing the same. Let's look at this at the daily chart level, where primary 3 high here is this point here. For this wave count, the triangle is a fourth wave structure, and now this movement fits really well as a 5-wave impulse. If primary 3 was over here and primary 3 began here, then subdividing as an expanded flat 3, 3, 5. It needs to continue intermediate C as a 5-wave structure. So far, 1 and 2 may be complete. It now needs to see 3, 4, which must remain below first wave price territory, and then 5, which should move beyond wherever 3 ends to avoid a truncation. The target is for primary 4 to reach down to the 0.382 Fibonacci ratio of primary wave 3, and it may find support at the lower edge of the adjusted Elliott channel. This channel is very important in coming weeks. Draw it from 1 to 3, place a parallel copy not on 2 but pull it lower to sit across these lows here. That may be where primary 4 finds final support. This price point is the price point which very strongly and clearly differentiates my bull and bear wave counts. For this bullish wave count, primary 4 may not move into primary 1 price territory. A new low by any amount at any time frame would firmly invalidate the bullish wave count at this stage and add substantial confidence to a bearish count for gold. I will not allow any overlap for this wave count between 4 and 1 because the data I am using from bar chart is cash market data. At the hourly chart level, the wave counts are now exactly the same. Minor 2 ends here, minor 3 is underway. Well, not exactly. The target for minor 3 here is a little bit different. This would see primary 4 end around about its target and see it remain within that channel. A 5 is down is complete here. A 3 up may continue early next week to bounce to either the 0.382 or 0.618 Fibonacci ratios. Minute 2 may not move beyond the start of 1. At the weekly chart level, at the last high for gold, There are a couple of bearish long upper wicks. This candlestick here is a bearish candlestick reversal pattern called dark cloud cover. It had support from volume, actively pushing price lower compared to the week immediately prior. And it came at a point when the trend was very extreme. ADX was above 45 and it's above both directional lines, and RSI was strongly overbought. So the trend was very extreme. Conditions were clearly overbought, and then we see a bearish candlestick reversal pattern. It's those conditions in which we take a bearish candlestick reversal pattern, particularly at the weekly chart level, quite seriously indeed, followed by a couple of weeks of downward movement with a really long upper wick on the next bearish candlestick at the weekly chart level, also volume actively pushing price lower. This last completed week technically is an upward week with a higher high and a higher low, but the candlestick has closed red. The upper wick is a bit longer than the lower, but there is a bit of a long lower wick there. Volume within the week is actively pushing price lower, but let's look inside the week for a clearer idea of the short-term volume profile. ADX is still telling us there's an upward trend, but it's very extreme. It's above both 45 and directional lines. ATR showing an increase after price broke above resistance, might now be starting to flatten off, but there's not really enough data here to tell if this upward trend has stopped. RSI still in overbought territory, but not extremely so now. Stochastics back in neutral territory, MACD fully bullish. What about the shorter term picture at the daily chart level? For GDX, the little flag pattern looks really clear, but now for gold, it just doesn't look that clear. It's really not a very good one. Gold is essentially consolidating with resistance about 1540 and support about 1490. We need to see a break above resistance or support in order to have confidence in the next trend. After the high here from gold, this bearish candlestick pattern is an engulfing pattern. That's the strongest candlestick reversal pattern. This one is particularly strong. It engulfs the the real bodies of the previous 7 candlesticks immediately prior, and it had support from volume actively, strongly pushing price lower. This is a very, very strong bearish indicator that we likely have a high in place for gold, at least for the mid-term, if not the longer term, but for some reasonable time back up here. On-balance volume is constrained and it's moved down from resistance on Friday. That's a weak bearish signal. While price is consolidating, on-balance volume is also constrained. Sometimes on-balance volume breaks out of its trend lines prior to price breaking out of a consolidation, and when that happens, on-balance volume gives us a signal. And so let's watch this resistance and support line closely. RSI is back well into neutral territory. There's plenty of room for price to rise or fall. ADX at both daily and weekly time frames indicated the previous upwards trend reached very extreme. It's now declining. We should be looking at trending reversal indicators, and we get one here with this candlestick pattern. If there is a new downward trend, ADX is a lagging indicator. It's going to take some time to catch up. ATR is declining or essentially flat as price moves sideways. Stochastics in neutral territory, room for price to rise or fall. MACD bearish but not fully so. That's all from me with your gold analysis. I hope all our members are having an awesome weekend.